As we head into the last stretch of the year, markets have been a bit bumpy. That's pretty typical. Investors are digesting a lot at once, from interest rate expectations to questions about the pace of the economy. And while the headlines can feel noisy, what we're seeing still looks like a normal reset in expectations, not a sign of deeper trouble. Walmart's latest earnings were a great real-world example of that. They posted solid sales growth, e-commerce was up almost 30%, and inventory barely moved despite higher volumes. That's a company getting more productive, using data, scale, and early AI tools to move faster and keep costs in check. It's also the bigger macro story we've been talking about. When companies become more efficient, they don't need to hire aggressively, but they also don't need to cut. And because they're getting more output from the same workforce, they don't have to raise prices to protect margins. That's one of the reasons we're not overly worried about a second wave of inflation. We also saw encouraging movement in consumer sentiment, with both 1-year and 5-year inflation expectations ticking lower. For the Fed, it's that downward trend that matters most. And on the volatility front, pullbacks like this are incredibly common. Even in strong market years, you typically see several stretches where markets give back 5 to 10% as the expectations recalibrate. It never feels great in the moment, but this really is the price of admission for long-term compounding. So as we wrap up November, the bigger picture still looks intact. Companies are adapting, consumers are being thoughtful but still spending, and inflation continues moving in the right direction. Thanks for watching, and I hope you all enjoyed some time with family and friends over Thanksgiving weekend. I'll see you next week.